All right, let's go ahead and get started. Today we are recording this class. It is Monday, October 7th, and essentially, recording is on. What we're going to do today is really three things. One, we're going to kind of go over homework 6 and the solution to that. Two, we're going to practice some more on the ROIC tree and the CFI. And then 3, we're going to talk about homework 7, which is going to be a much more advanced ROIC tree and CFI analysis you're going to have to do for next week, right? And so before I get started, I'm going to pass out the attendance sheet, and I am going to share my desktop. So I am recording what's on my screen. But again, here is the attendance sheet. Make sure you sign the attendance sheet before you leave today. So for this week, you had to complete homework 6, which was an ROIC tree and CFI analysis for Target, or Target, depending on your pronunciation. So let's go back and let's do that. So here is homework 6. Here are the PDFs, and I'll start with the Target ROIC. As you go through this, you had to go through both level analysis. So I'll start with the ROIC tree, first level analysis. All right, at a minimum, you should say the following. So in 2020, Target's ROIC was 13.5%. 5 years later, in 2024, it fell to 12.7%. That was a 5.7% decline over 5 years, right? Why? Right? Reason number 1, tax rate. In 2020, Target's tax rate was 22%. In 2024, their tax rate was 21.9%. So virtually unchanged. So really, the tax rate did not have any meaningful effect on the ROIC. So all of that decline for Target was pre-tax ROIC going from 17.3 to 16.3% over the 5 years. Okay. So drivers 2 and 3. Why did the pre-tax ROIC fall? All right. Reason number 2, operating margin. 2020, their operating margin selling their products and services was 6%. In 2024, it fell to 5.3. That almost 11% drop hurt the ROIC. So a reason the pre-tax ROIC went down is they're making less on every sale. Reason number 3, invested capital to sales. To drive $1 of revenue in 2020, Target spent 34.5 cents. To drive a similar $1 of revenue in 2024, Target spent 32.7 cents. That 5.4% decline actually would have improved the ROIC, right? So all of the decline in the pre-tax ROIC for Target and the after-tax ROIC for Target was the drop in the operating margin. Second level analysis. Why did the operating margin fall from 6 to 5.3? Now we're going to the next level of the P&L. First, gross margin. Gross margin, price minus cost of goods sold, and the product sold at Target went from 33.1 cents to 30.2 cents. That decline in gross margin had a big negative impact on the operating margin. Second, spending on selling general administrative / overhead expense, right? In 2020, they spent 23.8 cents in SG&A. In 2024, 22.3. That's favorable to the operating margin. That would help them. In 2020, their depreciation was 3.3 cents per dollar. In 2024, 2.6 cents per dollar. That decline in depreciation was also favorable, right? So the primary reason the operating margin fell was the drop in the gross margin, right? That really hurt Target's operating margin over the 5 years, okay? Look at the balance sheet. Why did the balance sheet productivity improve? 3 drivers. First, working capital. In 2020, Target had negative 2.9 cents per dollar on working capital. 5 years later, in 2024, it was negative 1.9 cents per dollar. So even though the working capital, was negative, it was less negative, which actually hurt productivity. You're essentially spending an extra penny on invested capital. So that hurt the IC to sales. So that's not why it got better. PP&E, property, plant, equipment, in 2020 was 36.5%. 2024, it's fell to 33.9 cents per dollar. That was a big improvement. Okay, so essentially got more revenue out of the same stores. And finally, intangibles. Remember, intangibles exist when companies do acquisitions. Right? It's the difference in the purchase price and the value of the assets that are purchased. Okay, so in 2020, they had about 1%, 0.009 of intangibles. 5 years later, 0.006 cents. That is slightly favorable on the goodwill and intangibles, right? So that improved it. But the primary reason the invested capital sales improved was the PP&E to sales improving. So summarizing, that improvement in PP&E to sales going from 36.5 to 33.9. Primary reason the invested capital sales went from 34.5 to 32.7, along with a drop in gross margin from 33 to 30, led to a decline in operating margin from 6 to 5.3, which more than offset the productivity improvements to drive pre-tax ROIC down from 17.3 to 16.3, and with a virtually unchanged tax rate, an after-tax ROIC from 13.5 to 12.7, right? That would be kind of ideal in terms of the walkthrough of the explanation. Questions? That's your template for how the TA should be grading homework 6. Beginning and use numbers, talk about the impact of the driver to the left, summarizing to overall ROIC impact. That's called the ROIC tree analysis. Now for this assignment, we focused on 2020 and 2024. Starting with the next assignment, we're going to care about the intervening years as well. Okay, so it's not like there was a black hole for 3 years, right? What happened on the road from 20 to 24? Right? Did anything big change there? Right? If we were looking at target, one of the things we would have noticed, this is now beyond your assignment for last week, is the ROIC fell precipitously between 22 and 23. It peaked at 25% after tax in 2022, fell to 9.3% in 2023, before rebounding to 12.7%. Right? So it wasn't just a straight line over the 5 years. It's kind of a little bit of a roller coaster. Right? They really improved, they went way down, and then they kind of recovered. Right? Same thing when we look at their operating margins. Operating margins were improving between 2020 and 2022 from 6 to 8.4, but then they plummeted to 3.5% in 23 before rebounding to 5.3% in 2024. Okay. So the question would just jump out at you, why? What happened in 2023? Right? Matter of fact, invested capital sales, which were improving from 2020 to 2022, fell as low as 26%, spiked in 2023 and 2024. Like, what happened? What caused that? Right? And specifically, what caused that for target context, if you looked it up, which you would say in your next assignment, is COVID. Right? Remember, these retailers report January fiscal years, not December. So 2023 on here is actually 2022. And that was the heart of COVID. And that was the problem that Target ran into, is that their margins fell during COVID, particularly as we were in that kind of transitionary year of 22 after the first hit in 2021, and then 2022 got a little bit worse. So that's part of the rationale for what's going on, but that's the point. Like, when you notice outliers, so you have to explain every number every year, but like, what are the trends? And if there's big outliers, what would be behind the outlier? There should be some context behind it. Right? Your second part of your homework assignment for last week would have been to go through the CFI. Again, focusing primarily on the total column for this assignment. And you start out with free cash flow. So you start out with Target generated over 5 years, $15.1 billion of operating free cash flow. Right? They generated $36.6 billion of gross cash flow from their income statement, no PAT plus depreciation. They reinvested of that $21.5 billion of gross investment in CapEx and working capital back to their balance sheet, giving them free cash flow before acquisitions of about $15 billion. They really didn't do a lot of investment in goodwill, no major acquisitions. So that gave them an after goodwill, free cash flow of 15.1 billion, right? Somehow I screwed up on copying over the percentages, but that gross investment's not 3.1. It's the 21,500 divided by the 36,580.7, or about 59%, right? So they had about a 59% reinvestment rate over the 5 years, right? Which suggested that they had potentially a 41% payout rate, right? And if you look at the 2024 CapEx depreciation ratio of 182%, that suggests for their fiscal 2025, they still expect it. Once we've explained the operating free cash flow, we move on to CFI. How did 15.1 billion of free cash flow turn into 15.4 billion of CFI? Not much change in the non-operating assets, right? We still got to talk about the non-operating items. So the big one, 403 million of non-operating gains, kind of adds to your CFI, right, for the free cash flow. They put $1.6 billion of cash into savings, in excess cash, that reduced their CFI. And they got about 1.487 billion of profits by getting rid of non-operating assets. So that basically helped their CFI. When you net it all together, their CFI was about 300 million higher than their free cash flow. And they had about 15.4 billion to pay out. And then finally, where did the money go? Where did they distribute it, right? Of the 15.4 billion, 2.25 billion went to pay interest to the debt holders. They borrowed 6.2 billion in new debt. They paid 8 billion in dividends, 8.068 billion. They bought back 12,492 million of shares. So that's about 20.5 billion to the shareholders. Well, the way you give 20.5 billion to shareholders on 15 billion of CFI, that's why they borrowed the $6.2 billion worth of debt. Okay. So again, at a minimum, things you should have mentioned. Those are the things you have to kind of walk through. Questions about any of that CFI walkthrough or essentially your write-up? Yes. Would you do what? Well, absolutely. Or Bloomberg, which is really helpful. But here's the point. Like, if I'm looking here for outliers, what do I notice as an outlier, right? Gross cash flow went from 6.2 to 7.2, kind of an increase over 5 years, but peaked in 2022 at 9.6 billion, fell dramatically in 2023 to 5.8 billion. That's the same item on the ROIC tree where the margin dropped. Like, why did it drop so precipitously? That'd be a question that would probably jump out at you, right? I didn't see any big investments in goodwill, so I don't see any big acquisitions, right? Again, I saw a big increase in excess cash in 2021, and correspondingly, when did they increase the debt? It wasn't in 1 year. They kind of increased it each year over time that they increased the debt, right? And the dividends were pretty consistent, growing over time from 1.3 billion to 2 billion. But the share repurchases, essentially the biggest one was in 2022. And then they didn't repurchase at all in fiscal 2024. So again, just a couple of things that jump out at you. They would jump out at me, and that have a little context, like why they do no share repurchase last year. Why they increase it in the middle of COVID? Probably because they were trying to prop up their share price, right? And ultimately, they were still expanding over the 5 years. They tried to grow, but they did have a dip in margin for 1 of the years. So why they dip in margin? So that would be the extra that I would talk about for next week. Questions? Other questions? Hopefully everybody got something close to this for this assignment. It's the way the TAs are going to be grading this. Right? But as I said, as we go into future assignments, it's no longer just the beginning and the end. We got to also talk about major trends in the 5 years and any big outliers that we notice, right? For both statements. So what we're going to do right now is we're going to practice, right? So I put into the files folder of Elms a folder today called NVDA, which is Nvidia. And in the Nvidia folder, there is an ROIC tree and a CFI for Nvidia. I'm gonna give you a few minutes in class to practice, not for a grade, study buddy here. Just pick somebody near you, 2 or 3 people, kind of go through this. Here's the difference though. Rather than me go through this, you're gonna go through this and explain this. And if I don't have a volunteer, then I'm gonna volunteer you. Okay, so we are gonna have you guys explain the ROIC tree and explain the CFI. Okay, and so in the last section, I will tell you the people that I looked to volunteer were the people that were avoiding eye contact, looking down at their keyboards, and hoping I wouldn't call on them. Those are the people I were calling. Right, so it's in your interest to have volunteers, so I don't have to do that. But nonetheless, that's what we're going to do because it's more important that you practice than I practice. I do this for a living. You guys need to know how to do this. So give you about 15 minutes, kind of walk through these, take your notes, and then we're going to practice because in a couple weeks, you're going to be doing this in front of the room for 10% of your semester grade. All right, so I want to make sure that we have plenty of practice getting these statements done. All right, so go. All right, let's go ahead and get started again. All right, let's start out with the Nvidia CFI. And what I need is a volunteer to go through the first level drivers. Who wants to do the 5-year first level drivers? Any volunteers? You want to do it? All right, come on up. Unfortunately, because I'm recording this, I need you to talk where the microphone can hear you. So you can stand right there and look at the screen, but I just need to capture your audio. So go ahead.
So Ben, you're
okay.
See that the tax rate actually increased, which shouldn't have helped the ROIC. If anything, that would drive it down.
Okay, from what to? Do from to.
Oh, like operating margin?
No, the tax rate went from.
Oh, the tax rate went from 5.9% to 12%.
Okay.
105%. This should have made the ROIC go down.
Yeah.
But the pre-tax ROIC went up by so much that it
okay.
66, which was 150%.
Okay.
That was due to their operating margin increasing by 26.1 cents to 54.1 cents. And that was 107.6% increase. And that helped their ROIC immensely, as well as their invested capital to sales went down, which also helped their ROIC. It went from 39.2 to 34.8, which was a negative 11% decrease.
Great, excellent. Like, couldn't have done a better job myself. So really, really good. So give a round of applause. Keep your soft strong. And that's exactly what you would need to say in your presentation, and he would have kicked off for his group really, really strong. So good job. Now, again, right now we're doing beginning and end. Talk about the middle later. But who wants to go next? I need somebody to go the operating margin second level drivers. So to explain using these 3 things, why the operating margin changed. Come on up. And if you want to stand right there, save us in the way. All right, go ahead.
Okay, so the gross margin for Nvidia went from 65.5 cents in 2020 to 75.2 cents in 2024, which is a favorable increase for the operating margin.
Okay.
14.8% increase. Also very favorable for the company. Their selling, general, and administrative expenses, SG&A, decreased from 35.9 cents to 18.6 cents, which is almost a 50% decrease. The equation to get operating margin is gross margin minus SG&A minus depreciation. So SG&A decreasing by so much was very favorable for the operating margin. Additionally, their depreciation went from 3.5 cents in 2020 to 2.5 cents in 2024, almost a 30% decrease. Again, look at the equation, this decrease helping the operating margin increase so substantially.
Great job. Good job. All right. So what we pointed out is all 3 of those factors help improve the operating margin, which were a driver of the ROIC going up. So really well done. All right, got one more person, need to do the second level balance sheet drivers. So explain how these three add to that. Who else wants to follow in their footsteps? Nobody wants to volunteer? Okay, since you're scratching your back, but it looks like you were twitching to come on up, so come on up. All right, so you get invested capital to sales, second level. Go ahead.
Okay, so we want to see all these decrease on the equation here as you add them all together.
Yep.
So for operating or for start with intangibles,
Okay.
that actually went up, which is unfavorable.
From,
I'm sorry, it went up from 6.1 cents to 9.1 cents.
okay,
Which is almost 3% increase. That's unfavorable. Operating working capital also went up from 12.1 cents to 17.1 cents. This was a 41% increase, which is also unfavorable. But for PP&E over sales, it decreased by so much from 21 cents to 8.6 cents. It was almost a 60% decrease that it outweighed the other two. And that's what ultimately drove down invested capital for sales.
again, great job. So if this were a group, 10 out of 10. All right, so really, really good job at kind of connecting the dots, explaining the drivers. Questions about what they just did? All right, so here's the difference. Going forward, again, we care about beginning and end and the middle. Okay, so going forward, this would have been perfect for this assignment, but next assignment. All right, we noticed that Nvidia saw their ROIC peak in 2022 at 69%, fall to 27, and then spike to 136 after tax. So something happened in 2023. That's an outlier year. That should jump out at you. Okay. Same thing. Their pre-tax ROIC went from 70 to 26. Right. So something happened between 22 and 23 before spiking in 24. Their margin, which they talked about improving, went from 26 to 37, dropped to 16, went to 54. Right. Their productivity, 39 to 70, and then worked its way down to 35. So it wasn't a straight line for Nvidia. And particularly, we see two periods of interest. What happened in 21 to productivity? Why did it spike so much? Right. And why did the margins drop and recover between 22, 23, and 20? Right. So that's what I'd say. When somebody jump out at you, a little context would help. And that would be the point. Like, go look it up. What happened that year? And even we see in the second level drivers, a big drop in, or a big increase in SG&A. So the SG&A spending in 23 spiked, right? So what were they spending on? Were they just anticipating the big rollout of chips? And this was like an investment that's going to pay off in the future? It's a one-time issue, et cetera. But that's what I'm talking about, the context for the business issues. No different than if you were an analyst working on Wall Street, these are the things that would kind of jump out as big outliers. All right, so if you don't see any big changes, you don't have to really talk about them. And if you see some noticeable trends, like for example, that overall we saw the gross margin generally improve year over year, with the one exception of 23. We saw the depreciation get worse for a few years before it improved in 2024. Just kind of noticing a couple of trends. Questions about the ROIC tree? All right, let's see if we can get somebody else to do just as good a job at CFI. Somebody explain free cash flow for Nvidia with their CFI. Do I have a volunteer? You want to volunteer? All right, great. Come on up. The free cash, just as a free cash flow.
$6.2 billion.
Okay.
And because the gross investment was 18 billion, and then the reinvestment rate was 32%, that caused the gross cash flow to decrease to 33.
To which number?
To 33.3 billion.
Well, actually, it's two above. So the gross cash flow minus the gross investment is the free cash flow before goodwill. That's the 38. That's this one.
Okay.
So this minus this is that.
Okay.
Okay. That's what the 32% is. That's 32% of that. That's what's left.
Okay. And then it went down even further for
they spent 4.9
4.9.
billion on premiums for acquisitions, leading to 33 billion. And then that's great. If I were to go further, when did they make an acquisition? What year looks like the goodwill and intangibles? So we know somewhere in actually 2021, it went up by 62, 63. That increase suggests that's when they did their acquisition. So again, something Google search this, look at Bloomberg, who they bought. Like they clearly made an acquisition for $6 billion premium in that year. Okay, but otherwise, good job. I saw you're off one row, but you got the main thrust of what you want to talk about here. So thank you. Good job. Give a hand for that. Right. By the way, the only other item to mention is CapEx depreciation. Right. They averaged 168%, but in 2024, it was 128%. They're still suggesting that 2025 is a growth year because they spent more than their depreciation. All right, I need another volunteer to go from the 33.3 billion of free cash flow to the 9.3 billion of CFI. So what happened to the non-operating items? Red shirt, back row, you're looking down at your keyboard trying to avoid eye contact. That's a volunteer to me. Come on up.
So there was a net operating gain, which was an increase, and then
Of how much?
up to 65.
Okay. Yep.
And then I can't see what this one is, but there is an increase in 1.3.
I'll try and make it a little better. Does that help a little? It was kind of pixelated.
Interesting.
Right.
Okay. Decreases.
Okay. Of how much?
Of 17.6.
Okay.
And then an increase, I think, in net operating assets over liabilities, which also decreased the CFI
By 8 billion.
by and then
Exactly.
a positive CFI.
So after that 25 billion that they put in the bank for savings, as you said, 17 billion, and they increased their non-operating assets by 8, they still had CFI left of 9.3 to pay out. All right. So again, good job. All right. She got the major points there. And again, remember, good job to keep using numbers when you go through this analysis. All right. Don't just give me the trends. All right. So we got 9.3 billion of CFI. How did it get distributed to the debt and equity holders? Who wants to take us home? One more person. All right, you're rubbing your chin. That suggests that you are deep in thought. So come on up. So he's going to take us from the 9.3 billion of CFI and talk to us about how it was paid out.
961 million went to the debt holders via interest.
Okay.
And then Nvidia increased their debt by 9 billion throughout those 5 years.
Okay.
And then towards equity holders, they paid out almost $2 billion in dividends.
Mhm.
And they issued 1.4 billion shares, but bought back almost 19.6 billion shares throughout the 5 years. And then after some adjustments to equity of about 2.8 billion, they were left with 9.27 billion.
All right, so how much approximately did they give to their shareholders? Just add up those three approximately. Round off.
About 21 billion, 22 billion.
Okay, so 21, 22 billion. How do you think they afforded to pay 22 billion to shareholders if they only had 9 billion to CFI?
Via debt.
That's where the debt came from. All right. So that's the other insight that we would have had. So good job with the financing close for Nvidia. And those are the major points for last week that you would have need to have covered for the total column. Again, if you look at some in between years, a couple of trends probably jump out. All right. First of all, the gross investment for Nvidia in dollars actually peaked in 2024. Okay, they had a big investment in working capital, right? Why? Were they building up inventory? Like what kind of happened there, right? We also saw they did, as we pointed out, the acquisition in 2021, big jump in goodwill. Why did they have that big jump in goodwill? Who did they buy, right? And then on the debt and equity side, we noticed they increased their cash by 18 billion, 17.5 billion over the 5 years, but it wasn't a straight line. Like they put 12 billion in excess cash in 2024 last year, but in 2023, they actually decreased their excess cash. In 23, they increased their excess cash. So why are they doing that? What is there anything that's changing in the business that made them draw down some cash last year? Right. And then finally, we noticed that the dividends kind of were pretty consistent, going from 390 million to 395 million. But all the share repurchase occurred in the last 2 years. Just something to highlight. Okay. So it was really the last 2 years when they started buying back the majority of their stock. So, questions about the CFI? What to talk about, what to highlight, what you need to say. Considering this is the first time I've asked you to get in front of the group, brave souls that were called up here. Some volunteered, some I volunteered. Good job. And again, this is what we just more practice, get familiar with the statements, start to really understand what's going on with the businesses that we're analyzing. Okay. And like I said, in a couple of weeks, here's your, yes, go ahead. Absolutely. It just happens to be that these random companies that we've chosen, they are, but you could see situations where a company might not use debt to finance their free cash flow. Matter of fact, Target would have been a good example, right? Well, actually, Target did use some debt. We'll look at later in the semester a company that didn't, but that's the point. And we would see, all right, here's a company with free cash flow. They paid out their free cash flow to the shareholders. All right, so they didn't use debt. That's probably a more sustainable business. Or here's a company that had no cash flow and couldn't pay out the dividend, didn't have any dividends because they were losing money. So you could also see that situation play out. So I said, every company's going to tell a story, and that's the point. It'll be unique to that company, but at least we have a process to understand what's going on. Other questions? All right, so 2 things. One, originally next Monday was your second group project. Right, I decided to push it back a week. Right, so the second group project presentation is now going to be Monday, October 21st, rather than the 14th, just because I want to have one more week of practice before I jump in for another 10% of your semester grade. I will give you that company next week, and next week your team will work on putting together this analysis for the ROIC tree and CFI for the company that I signed and the context. 10-minute presentation. So this week we have homework 7. And I'll warn you in advance, this is going to be a tough assignment. On the way in today, I ran into some TAs in the hallway. And I said, expect a lot of people for office hours, right? So what is your assignment for this week? Your assignment for this week, which has been posted and updated, is on Southwest Airlines. All right, so I made some comments about some of the challenges Southwest had. That'd be interesting to see what's been happening to them over the last 5 years. So here's what I've done. This Excel file, right, is this file. And in this file, I am going to give you three sheets. 5 years or 6 years of Southwest Airlines income statements, 6 years of Southwest Airlines balance sheets, and some changes in equity, which are these other adjustments to equity. Okay, so here's 6 years of historical financial statements. That's it. Your assignment is to do a minimum 500-word paper write-up of their ROIC tree and CFI. Okay, now you'll note that I didn't give you the ROIC tree and CFI for Southwest, which means you have to create it. In order to create it, you're going to have to do the following. You're going to have to take these income statements and balance sheets, and you're going to have to create a TII, a TFI, and a CFI that balance. Then, from those, you create the ROIC tree, and from those, you create the total for the 5-year CFI that you write up. So in order to do this assignment, you got to convert the statements and create the analysis. I'm not going to give this one to you. And then you got to analyze it. So it's a big assignment. Do 1 week from today. Because it's such a big assignment, I'm giving you class time on Wednesday. So there's no class on Wednesday. You can use that time to work on this assignment because it's a lot of work this week. And I am also going to give you a one-time offer. Okay. For this assignment, you can use a study buddy, which means somebody in your section you can partner with to do this assignment together. Okay. And then you'll submit the assignment. You'll both submit it with both of your names. So both of your names in the write-up, both of your names in the Excel file. Right. And you can do one write-up for the two of you, work on it collaboratively, one Excel file, and you can choose to pair up. I'll call that a study buddy. But you have to identify who that study buddy is. Because if you submit a paper that doesn't have somebody else's name on it that matches, you're going to the Honor Council for plagiarism. Okay. But if you put in, I worked with whoever, two of us worked together, that's perfectly acceptable for this assignment. Now, if you're like, super brain and you're like, I don't need any help, I can do this all myself, you do it individually. Right. But if you think you need some help, you can work on this one collaboratively. Do 1 week from today, next Monday, 10 a.m. Yes. Correct. Sorry, what's your name? And what's your name? Alex. So Ravi and Alex work on this together. So you'd say Ravi, Alex at the top of your paper, right? And then you both submit that paper with both of your names on it to ELMS. Same thing with the Excel file. You both submit that Excel file to ELMS. And then because you're both your names on it, we know that you did this as a pair. Now you're going to get the same grade as a pair, but nonetheless, it gives you the ability to use somebody. So you can use your study buddy, just pick one, it's up to you. I can't use the same study buddies. Can't have more than 2 people in a group. Got to use it within your section. And whatever you do, this assignment is due next Monday. You also have the ability to take advantage of TAs. Their office hours are Thursday, Friday, and I'm going to ask if they can do some special office hours on Wednesday. Okay, because I know this is a tough assignment. But this is, by the way, a building block. Part of the reason I'm having you do this is what's going to be next. What's going to be next is we are going to go to valuation. And what you're building here is the basis for a reusable model. Because we could take what you build, replace Southwest income statement and balance sheet with Pfizer's, and then suddenly we got the basis for Pfizer's valuation. All right, all their statements get converted. All right, so you're building a reusable model, whether you like it or not, and this is where we're going to get started. All right, questions? So the assignment is up there right now. This class has been recorded on video. I'll be posting that shortly. As I said, there is no lecture on Wednesday. I'm giving you the extra time to work on this assignment. The next time we'll be together is 1 week from today to kind of go over all of this. Where is the attendance sheet? Make sure you sign the attendance sheet before you leave today. And otherwise, have a great week. Fun with that. Now we're in the real world. They don't give you the labels on the Southwest Airlines. Figure it out. But if you have questions, like I said, ask your team. What do you think?
I'm understanding the ROIC and everything, but for the CFI, when pointing out the numbers, because like ROIC, you're kind of saying this, 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 this.
Look at the numbers with the context of, on the top half of the statement. Is it adding to the cash flow that the business is taking? Or is it taking away? In the bottom half of the statement, you're pointing the numbers and saying, okay, did I take the cash flow and I give it to these people? Or did I have to get cash from those people? That's the context of the CFI.
Got it. All right, thank you.
Yep, good luck.